Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now from the Petersen Institute, the pride of Brookline, Massachusetts, Adam Posen. Adam, first of all, thank you for your important comments at Jackson Hole. Lisa and I really appreciate that. What's changed in 4 or 5 days, Adam Posen, from Jackson Hole in this Fed debate?
Thank you, Tom, for having me back, both there with you and Lisa and today with you and Paul. A lot has changed. 3 things. First is that the attacks on Governor Cook, as Paul Krugman and Larry Summers and many others have pointed out, have shifted into lawfare, meaning using the powers of the government to go after individual officials with quasi-legal means. And as Krugman, I think, put it very well in his Substack a few days ago, this is about personal intimidation. And to Dr. Cook's credit, she's not giving into that. Second, something that you were aware of and I was aware of, but we were sort of being discouraged from talking about too openly, is now front and center, which is the renewal, as you were just discussing with Mike, renewal of the Reserve Bank presidents at the end of February. And so whatever happens with Governor Cook, the question is, do you have a majority of Trump appointees who are willing to really mess with that process by the end of February? And then the third thing is there's just been such a limited market response to the event.
You mentioned, Dr. Posen, that the markets seem to ignore the moment, at least in the United States. Do you anticipate, I don't want you to make a market call, but do you anticipate that the president is unmindful that the markets end up telling authorities what to do? That's usually in history how it's worked.
Yeah. Tom, I think the current president is either falsely overconfident or unmindful. I mean, we all heard the stories about Secretary Bissett and NEC Director Hassett going through this whole elaborate thing in April to get the president to focus on the day that the Treasury market started going down a lot because of the China trade war. And all that illustrates, even if you buy it entirely at face value, is that the president wasn't thinking about that, and he wasn't asking for Bissett or Hassett's advice, or he wasn't listening to Bissett and Hassett's advice before that happened. So I think it's very clear that he is ignoring the markets. And I think he and his team have told themselves, as well as others, a story that a variety of things they're doing, including the forthcoming issuance of stable coins, creating demand for U.S. Treasuries, mean that they're not going to have to worry about this. And the other thing is, of course, the market is playing along. Now, fixed income market in the U.S. generally tends to be both more important and more savvy than the equity market. The equity market about these things is driven by other factors, and so shouldn't be read as much of a verdict on these issues, these being inflation, central bank independence, fiscal policy. Sorry.
No, go ahead, Adam.
No, all I was just going to say is, we're having a very lively internal discussion at the Petersen Institute about why the markets aren't reacting and why, for example, they are reacting so negatively to France. It's not so much that we don't think the situation is very serious in France. It's just, okay, why is the situation not at all serious in the U.S.? And we're having trouble understanding that.
Adam, there are those that say that maybe the Federal Reserve does need some changes to be affected there, that maybe they have not performed effectively over the last years, if not even longer. How do you think about that?
My view is that, as I've gone on the record on the program with you all saying, I think they did screw up by not changing monetary policy in early 2021 when the labor market turned around quickly and when the Democratic Congress passed additional unnecessary fiscal stimulus. I mean, they have screwed up. I think they've screwed up more on the financial supervisory side. What happened with Silicon Valley Bank and the other mid-sized banks that got a carve out and light touch supervision a few years ago was really bad. What they did and failed to do in 06, 07, 08 was really bad. So, but the question is, does that get addressed? Do either of those get addressed by undermining Fed independence, politicizing the appointments, creating, frankly, likely more lax supervision rather than less? I don't think so.
Adam, I had a private conversation at Jackson Hole with a leading banker. I'm not going to say who it is, folks. It doesn't matter. You have the advantage of Olivier Blanchard's perspective at Petersen Institute. This banker was heated that America taught the other banks independence at a central bank. For mere mortals, our listeners, our viewers, restate why we're going through this, why this independence of a central bank is so important, unlike the Bank of England years ago, unlike the Bundesbank, and unlike Otmar Issing's newfangled ECB.
Right. Okay. I think it is a fair point that the Fed was the example and the lodestar on a lot of this, although the German Bundesbank and the Swiss National Bank too. The rationales there are four big rationales for why it's in the public interest for central bank to have operational independence, meaning getting to set interest rates and monetary policy on its own. The first is the argument made by the brilliant Ken Rogoff in 1986 that there's inherently an inflation bias to various degrees in monetary policy, because if you pump up the economy, at least temporarily, you get some growth, but in the end, all you get is the inflation once people expect that. And so the point of the independence is to anchor expectations, as the saying goes. So you basically get rid of this extra inflation that's totally avoidable. And all the data suggests this is right, that you get a lower average inflation rate with an independent central bank at no cost. The next two are very straightforward. When you have a politician who wants to have a rate cut time for a particular initiative or ahead of an election, out of whack with what the economic fundamentals are, that's bad. When you have a government that wants the central bank to directly finance its debts so that the government doesn't have to behave in a responsible way, that's bad. We saw that in Italy. We saw that in Argentina. We saw it to a limited degree in Britain in the 70s. It's bad news. And so this election cycle insulation, this prevention of fiscal dominance is the other two main reasons why you do central bank independence. Again, I want to stress the late Stan Fisher, former vice chair of the Fed, former governor of the Bank of Israel, stressed the distinction between operational independence and goal independence. It's still the Congress, the legislature, that sets what ultimately is the Fed's goal, whether it's in the Humphrey Hawkins Act or 2% inflation target or whatever, and evaluates that. But the day-to-day, month-to-month independence is what we're talking about.
Paul, jump in.
And then finally, the issue is just the same way that the Trump administration is gutting expertise and technocrats and bureaucrats of experience throughout the government. They're now doing the same thing to the Fed, and that just makes policymaking worse.
So for individual Fed employees here, how does it impact the day-to-day, do you think? I mean, does it impact the analysis that they do? The data is the data. I guess they can interpret data how they want, but the data is the data.
Yeah, I think that's fair, and they certainly are going to try. I think what's happening, which is happening again at the Bureau of Labor Statistics, at the National Institute for Health, at the EPA, at a whole range of government agencies in the U.S. right now, is a combination of demoralization and depression. Demoralization that the experts who try to do the right thing and do all the hard work of trying to interpret the data and verify the data and come up with good sources of the data and improve the data get ignored more and more. and the amount of funding they get.
Right.
I mean, all this nonsense about a marble building and all that. You lose people because your salaries aren't competitive. The building is crappy place to work.
Yeah.
And so that's demoralizing. And then you have the issue that, you would never experience this, but think about having a bad boss. I mean, if you have a boss who you can present pros and cons, and sometimes she listens to you and sometimes she doesn't, fine, but generally actually values a debate, and suddenly you have a boss that listens to one particular shareholder. That's pretty bad.
Adam, we got to run. I got one final question for you, folks. I want to really lay this out because I think it's really eclectic. The Petersen Institute, like they have Jed Kolko as a non-resident senior fellow. He's really strange, wonderful economist. A guy named Nick Lardy, who's pretty good on China. Mary Lovely. A guy named Furman it's a school up in Boston. It's called Harvard. I think Furman's up there. The list of quality. One of my heroes, William Klein Chedbourne, Blanchard, as I mentioned. When you all sit around, Dr. Posen, are you just assuming a new embedded inflation? Not like Volcker 80s, but are we to a new regime of inflation?
Well, Tom, as always, I'm grateful to your appreciation and amplification of what our team does. I'm very proud of them. We literally sit around once a week with a lot of the non-resident people joining, 20, 25 people joining us online, and there are 20 people in the room, and have a working lunch meeting. Sometimes it's about research. Literally yesterday, it's on Tuesdays, was about this. And like I said, we're wrestling with why the markets aren't reacting, what the inflation outlook's going to be, how soon, how bad. I think we're all pretty convinced that the tariffs, and especially the anti-migration, is going to pass through to higher inflation over the next 6 to 9 months, meaningfully higher, like 4 or 5%.
Wow.
And we are worried that the Fed will change, and we're very worried about the Reserve Bank presidents, because as Jason Furman, who you mentioned, and other Fed alums like Karen Dinan and David Wilcox and Ray Upsall have argued, if the committee's still the committee, there's a limit on how much they can screw up on inflation, no matter who Trump appoints. But if suddenly we swing to a number of the Reserve Bank presidents are not reappointed, and they either don't get the vote or they're replaced by cronies, then that goes out the window. That guardrail is gone.
We got to run. Adam Posen, thank you so much. The takeaway there, folks, is if we get 4 to 5% Adam Posen inflation, guess what? The dialogue changes. It's just as simple as that. Dr. Posen from Jackson Hole and from the Petersen Institute in Washington, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
With us right now, Mandeep Singh. He's Global Head of Tech Research as well. So in the mystery of pre-conference call, for you, is it a study of unit dynamics within the different divisions of Nvidia, including data center? Is it a line on the income statement? What's the Mandeep Singh mystery that you're going to be looking at?
I mean, right now it's about the data center revenue, because that is revenue. Earnings will come simply because this company has a monopoly when it comes to the GPUs that they're making. They can charge whatever margins they want, and that has been the case. So it's a question of top line.
So in technology, they can hold price or even increase price?
Well, they keep releasing new architecture. So with Blackwell, they will increase price. With the new architecture that's upcoming in 2026, they will increase price. And the lower SKUs that are outdated will be sold at lower prices compared to that.
Mandeep, Tom just forwarded me some research from Rob Schiffman, Bloomberg Intelligence credit analyst who covers the technology space from a credit perspective.
It's not Mandeep.
He's got a lot of pretty pictures, which I like. But what it shows is just this huge capex for all these companies. And the bond market, I guess, is fine with it. But, I mean, is somebody asking a question like, are you guys getting any return on this CapEx?
Well, the cloud companies have shown return. We saw Microsoft's Azure segment growth increase to 39%.
Okay.
17% of that growth was AI workload driven. So from that perspective, the cloud companies have shown the ROI for sure. It's the other smaller software companies. They are the ones who are still struggling to figure out what's the right product based on LLM. How much do we charge the customer? Right. And can we increase our margins for that?
Schiffman's core theme, I know you two never talk, but Schiffman's core theme is that investor payouts display strength, not strain. Why is Amazon? He's got this fancy Mandeep Singh bar chart here. Amazon's not participating in dividends and share buybacks, are they?
They're not, but look, when you are at the scale that Amazon, Microsoft, and Google are, it doesn't matter, they are doing dividends or not, because they are growing top line at the scale that Amazon is, 500 billion plus in revenue. If you are growing top line double digits, that's huge. And that's what investors care about. The free cash flows will come. It's just a matter of turning on the dial.
It's all going to end. It's all going to end.
Is there...
Lighten up on the Mag 7.
Exactly. Is there a bear case for Nvidia out there? Like when you go out there and talk to institutional investors, do they push back on anything?
Oh, absolutely. I mean, Nvidia is not the same company as it was 8 quarters ago when everyone underestimated the size of this market. Now the expectations have gone to a point where everyone expects them to beat and raise by $3 billion for next quarter. And look, if you're a software company right now, you're trying to optimize what are the type of use cases where I need to use Nvidia GPUs and others where I don't. There is no one size fits all here. You want to optimize for token pricing, which is a key metric in AI. And that's where I think there is a bear case that you can build around Nvidia's growth expectations being too high.
Okay, here's our plan. We want you in every day this week, Mandeep, so you can rock it Thursday and Friday. I'll be here Saturday if you want to come in.
I can join.
Is Monday Labor Day? I don't even know.
Yes, it is.
I have no life. Is it?
Yeah. We're done. It's early Labor Day.
I'll be here Monday.
You got to go to the Open, Tom. There's so much.
Did you go yesterday?
No, I'm going this weekend. You'll have to excuse me on one of these days.
Paul had your $23 beverage, so you don't have to buy it.
The honeydew.
He made a honeydew.
Yep.
He made his commitment to it. Mandeep Singh, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're thrilled to bring you Amanda Agati. She is with PNC Bank. Amanda, let's start with a why. Why are stocks ignoring the Trump-Cook battle?
Well, good morning, guys. It's always great to be with you. I think the equity market is really largely ignoring it. One, because it's starting to get conditioned to a lot of this purple haze of policy uncertainty. But two, because I think the bottom line is rate cuts are more likely than not, regardless of what ultimately happens with Cook. And I think that is the most important thing for the equity market's path forward.
So the equity markets, do they hinge around Mag 7 and Nvidia performance, or do you see a legitimate rotation at PNC Bank?
Well, it's hard to bet against the Mag 7, and certainly it is Nvidia earnings day, so everybody's focused on, how strong results are likely to be. But we actually have seen expanding market breadth over the course of the summer, and a lot of it's been fueled by how strong Q2 earnings season actually was. It wasn't just about the top 7 or the top 10 names. And when we look at revisions for Q3 and even in the balance of the year, we're seeing that breadth story take hold. So I think that's a really important fundamental and healthy aspect of the market rally, even as it stalled out here into the end of the summer a little bit. But given where valuations are, it's healthy. We're not hanging our hat on just one name, even though today is a big day for sure.
So today is a big day, Amanda, as you mentioned, Nvidia. But talk to us about just earnings in general. The second quarter earnings came in much better than expected, I think. And the question is for a lot of folks, is that enough to continue to push this market higher? How do you think about earnings?
Well, Q2, there's no question Q2 results were a monster relative to where we started. Now, the bar had been set pretty low because everybody was freaked out, technical term for you, as it relates to the impact from tariffs and trade potentially hitting in Q2. Of course, it didn't hit squarely in Q2. We punted it a little bit into Q3. So the results came in, I think, even much better than a very low bar that was set. And I think the results continue to suggest that there's still a lot of fundamental strength here. We're not seeing a lot of weakening. Q3 is really what's important in terms of the rally, and revisions have been creeping quite a bit higher.
Bloomberg working 24/7 on the Fed Trump uproar. Just three headlines here. Claudia Sam Publishing: Federal Reserve shouldn't take the political bait. John Authors, who's been absolutely brilliant: firing Lisa Cook won't be enough for what Trump wants. And Jonathan Levin: Powell won't save the Fed, with silence. Amanda Agati: here's Bill Dudley, economist, saying markets are too complacent. Even if Trump stands only a small chance of taking control of the Fed, the effort itself is disruptive. So how do you change an equity strategy for our listeners and viewers? You know, whatever the outcome, there's going to be disruption at the Fed, right?
It does seem as if there's going to be a lot of noise at the Fed. There's no question about that. I think at the end of the day, though, the forward guidance and the dot plot and the path is really what's going to matter the most. So is it 25 basis points? Is it 50? Is it ultimately 100? You know, a series of cuts into next year.
Is PIMCO modeling a Besant-like 4 rate cuts?
We are looking at potentially 100 basis points worth of cuts, but not all into the end of this year. It spills over into early 26. But so if that's the path, then we're not pulling the ripcord and raising a ton of cash and moving to the sidelines. That will create a decent amount of support for the market here, and certainly for the earnings and economic backdrop. So we're tweaking positioning. So we've been talking about quality as being a really important place to be for investors all year. Quality is getting pretty fairly valued or fully valued here. So we are tweaking at the margin, but we're not feeling particularly, negative or bearish kind of going into the end of the year if the Fed is going to continue to be accommodative.
Amanda, thank you so much. Amanda Agati, a brief here from PNC Bank this morning, where she's CIO Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Joining us now from Staten Island, Anthony Crescenzi, Executive Vice President in PIMCO. The way he rolls is Staten Island, the fam.
Yep.
And then he goes down to Latin America to actually look at the short-term
Argentina.
Paper market.
Good states
well.
there, a lot of Italian speakers too.
Okay, but here's the reality. And I've had the honor of being in the acclaimed PIMCO meeting in Newport, and all these smart guys are in the room, and all I know is Staten Island electricity is up 54% since 2019. You are the king of short-term paper. Are you telling me there's no inflation out there?
Well, there is. In fact, there are studies that indicate that in urban areas, big cities, the inflation rates are higher than in other places. On Staten Island, by the way, I have a solar roof to power my electric car. So I kind of escaped the very high rates, almost 40 cents a kilowatt hour. Elsewhere in the country, it's a lot less. The inflation rates are higher, but the inflation expectations are anchored. 3 years ago in Jackson Hole, where I saw, Tom, you were last week, Chair Powell gave a speech where he said there's 3 lessons of history for battling inflation. One of them is to take responsibility for the inflation problem. Secondly, to pay attention to inflation expectations, how people feel about it, which Janet Yellen tells us, and she's an advisor to PIMCO, is key to the inflation story. And finally, this is very telling, Powell said, keep at it. That's a direct quote from reference to Chair Volcker, who wrote a book called Keeping At It in 2018.
And Clarida has been a huge supporter of the program, our Fed Day as well. Professor Clarida, again, advising at PIMCO, with us from Jackson Hole. None of you have ever modeled the upset in the Fed we have now. How does a Pacific Investment Management Company feel about an unhinged, non-independent Fed?
Well, as I said, that a key lesson of history, as Chair Powell said, is to take responsibility and pay attention to inflation expectations. if the members of the Fed collectively decided against that and decided to persist, to drop their persistence against the inflation fight, that would be a problem. Now, where this all goes is above all of our heads. It's a matter for the courts, of course. But what we should expect is something that we all learned in grade school, which is the idea that there's checks and balances. And so far, the checks and balances are working. We know one major check and balance in this whole story will be, of course, the Senate Banking Committee, where it'll be very difficult to push.
We talked to
Libby Cantrell. Libby Cantrell.
She's the PIMCO as well. What is this PIMCO week?
She will tell you that
she was on fire yesterday.
There's just one seat majority, 2-seat majority in the Senate Banking Committee, 3-seat majority in the Senate, makes it very difficult to push nominees through. And it's proven, in fact, in the first Trump administration, 5 suggested appointees did not make it through the Senate. So there are checks and balances here. And so it's part of the reason why markets are even keeled about the story. They expect those checks and balances to work out. And so we'll have to wait and see. And we would expect that will be the case in the end. But one can't know for sure.
All right. On the beach at the Jersey Shore this weekend, I'm sure many people are going to come up to me. I have a house there, by the way. There you go. Are going to come up to me and say, why is it a problem if President Trump stacks the Fed? Tell me why it's a problem.
Well, I've written for a long time. I've written 6 books, and one of the first book I wrote in 2002, I talked about the key situation in the 90s, 1994, when Chair Greenspan raised the policy rate to 8%. I called that tough love, medicine, something that's needed to get the interest rate levels down in the long run. Now take it the opposite way, pull away the medicine, and you have a different story where the disease, inflation, the bond market's nemesis can get out of control. We need to keep interest rates at certain levels, as I said, to keep the inflation expectation down, because that's what's embedded in long-term interest rates. And Paul, yesterday there was a great article by Bloomberg's Simon Flint. I say run, don't walk to read it. He talks about how the term premium, which is the uncertainty element for longer term rates that affect mortgage rates, that could rise, he thinks, based on the uncertainties that exist today. And so if there's more uncertainty about the future, about inflation itself, then a lower policy rate in terms of what it might mean for the future, that becomes more uncertain, and hence longer term interest rates might rise, not fall. The opposite of 1994, when higher interest rates knocked the interest rates down. You could even cite the recent example, of course, the Federal Reserve raised the policy rate significantly after the pandemic, and it's caused interest rates lately to fall. So you can get that because it's medicine, it's tough love, it's what's needed in the end to keep interest rates down.
What did you take away from Jackson Hole here from Fed Chairman Powell?
Chair Powell is continuing to heed the lessons of history that he cited in 2022, and that is very calming. And he does seem to be doing everything it takes to defend the institution, and that is, for a bond investor, highly, highly admirable.
Do you see in the Crescenzi short-term paper market any nuances, dynamics, smoke signals, like what I'm seeing in Japan 20, 30, 40, France 30, Netherlands 30?
There still seems to be an excess of so-called reserves, money in the system that's keeping the short-term interest rate market relatively stable. That some of that money's going away because the Federal Reserve is shrinking the size of its balance sheet. In other words, taking money out of the system. It had a $9 trillion balance sheet. It's moving down toward $6 trillion now. It's in the mid-6s, and that's taking money away day by day. And so we'll have to watch, Tom, for those signs as the year end approaches, because that's where you get the signs in the year-end information in terms of the interest rate for the December 31st.
Have you taken Libby Cantrell to Campania in Staten Island? I mean, it's like she could rock there.
Is an amazing worker, amazing human, and she travels a lot, and so she
but
probably
it's like
get there.
Celeb hangout where, like she was like, it's like where the cool people
she's
go.
done some amazing things for the community and for PIMCO, and we're great to have her.
What's her distinctive Washington take where you lean into the report and read the sentence?
She uses the word perfunctory a lot in her write-ups. I looked it up to make sure I understood exactly what it means, which is to say the Senate won't necessarily give in to President Trump on nominees that he selects to be part of the Federal Reserve. And so that's important. So that's the key word of the day. Perfunctory don't expect the Senate to just give in to the president's desires on the Fed. And that's important to investors today.
This is about as good as it gets for you bond guys, isn't it? I mean, you got nice yields, nice paper. I mean, credit quality is pretty good. I mean,
Paul, it's a nirvana is the way I like to call it, because yields are between 5 and 7% for a AA minus average credit quality. AA, according to Standard and Poor's and Moody's,
nice.
is how much
Nailed
mix them together. That's a 99.98% chance of getting your money back. So you need to do a lot in the bond market to obtain a yield that's attractive relative to history, expected inflation, which is in the 2s, and expected volatility, which is in the low to mid single digits. That's a nice story. And what I worry about most is not locking it in. It's in the same way that homeowners locked in the low mortgage rate, they should lock in high interest rates on their income.
Okay, one last thing, and we're running out of time. Just because you were here, I took H15, 10-year and 30-year back forever, like back to 1822. I'm kidding. But the answer is we're starting to see a curve steepening in 10s, 30s. What does that signal to you? Is that an unraveling of the long duration market?
It is not. Does reflect, as Simon Flint noted in his article, that some increase in the term premium. The big story, we only have a few seconds, look up World Bank global saving rate. You'll see for the first time in 40 years, it's declining because of increased spending on defense, rewiring the global supply chains, tech spending. Money is getting used in places that for decades went toward financial assets, keeping yields down.
He's got solar panels on the roof in Staten Island. It's Crescenzi against Con Ed. Thank you, Tony Crescenzi.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.